Investonline structures risk-profiled and diversified unit trust investment portfolios from the top-performing unit trust funds in South Africa to assist their clients in selecting the better-performing funds. Joining us to discuss the group's investment strategy is the director, Rod Lowe. Rod, thanks very much for your time. I see in terms of commentary that I've recently received, you are expecting the dollar-rand exchange rate to weaken over the next 3 to 4 years, and that with the potential crisis on the horizon, either a European sovereign default or the like. Can you elaborate on that thinking, sir?
Yes, Bronwyn, good evening. Last year in July, we went live on Business Day's website saying at 670 the rand, we thought it was an optimal time to switch rands into dollars from a technical perspective. And we said on a 3 to 4 year view, we saw potential for the rand to move out on a cyclical basis out to above 11 to 12, as it has done so twice in the last 10 years. So we put that out, put our neck on the block, went and advised clients to switch into dollars, but also to stay away from shares and to predominantly stay in cash or low equity. And a year down the line, the rand has moved to 8.20 this evening. So our clients our aggressive clients that took the currency bet are very happy with the move in the currency. And equity markets have done nothing in the last year to speak of. And going forward over the next 2 years, we see severe headwinds in 2013 and 2014. Specifically out of Europe, but also out of China slowing more than everyone's expecting, and also the debt problem in the US getting to 17 trillion and having to raise the debt ceiling again in October, November before the election. We see the headwinds globally as too strong, and that the risk-off trade is of probably a high chance of happening in the next 2 years, which will cause the rand to move out to those lofty levels that a lot of people aren't expecting.
Rod, Derek, just a question from my side. If you look at a client coming into a new client, potential client coming to you now, and you had to asset allocate that cash at the moment, just a brief overview, how would you look to allocate that cash and place it?
Interesting question, Derek. It essentially all boils down to the specific client's risk profile. So if it was a conservative client, the client doesn't like loss of capital, is averse to a loss of capital, is conservative on a 1 to 5, is a 1 or a 2. We would probably look at a maximum of 25% in dollars and 75% in ZAR. And then moving along that risk profile to your higher risk clients that are prepared to take volatility in their stride and are prepared to take a bet. And I say that in the best possible way, because buying shares is a bet, so buying currency is a bet. So your more aggressive clients, your 4 to 5 out of 5 risk profile clients that are able to hold money for 2 to 3 years and are happy with volatility, we would allocate as high as 75% into dollars, 25% into rands, on a view that we think that one of the best bets going forward over the next 2 years is currency weakness, and we do not see value in the equity market. So we're saying dollar cash is a better bet than buying shares, which we think will go sideways. That's our conservative view. Our aggressive view is we think shares are going to be negative over the next 2 years, globally and locally. So in light of that perspective, we think that the currency bet is relatively a mediocre bet in light of the fact that the global economic woes that are heading for us in the next 2 years are going to disappoint these markets, and the shares, I think, have got potential for drastic downside.
When you say drastic downside, I just want to go back to your forecast there. You're saying they potentially will give negative returns over the next 2 years, both locally and globally. Just reiterating your statement, is that correct?
Yeah, that's correct, Bronwyn. We think that the present behavior in a local market, which is pretty much a sideways movement on the JSE All Share over the last 18 months, is a classic topping formation. Clive Roffey alluded to it in his technical and analytical view earlier in the week, saying there's a massive divergence between the slightly higher top that was reflected in the last, I think in April, May, June, compared to the MACD. So we tend to agree with him on his technical perspective. On the fundamentals never really give you a warning of a massive direction and change, because fundamentals always are optimistic and bullish. They tend to motivate that earnings will unwind on a forward basis. We think that the debt situation in Europe and the slowdown in China and the debt situation in America are underpriced in this market, especially going into an American election in November, where we think, sure, we'll muddle through to November because, believe me, there's a lot of pressure
Rod, I'm going to bring it. I want to bring it back.
Sure that
I want to bring it back to studio, and this is quite a dramatic view for somebody who, as you feel, Derek, that equities are going to deliver positive returns, certainly over the next 2-year period. I had Peter Brook from Omixa yesterday saying that he's expecting a 6.5% real return from equities over a 5-year period.
Yeah, and I think it's a very conflicting view in that it's basically a risk aversion trade as opposed to a risk on trade. So now, you know, if you're betting on rand weakness, my sense of it is that you are going to start to see a flurry of cash into treasuries and a lot of money into those safe haven assets. However, if we look at the statement that was made not so long ago now on the show, the equity market, and I looked at it yesterday, has basically given you an on average about 5% return from June to June year on year. Now, that said, you've had huge declines in the resource space, but you've had huge gains in the industrial space. So if you had invested in some of the heavyweight industrial stocks like the likes of an SAB or a Tiger Brands, even in the property sector, you would have done very nicely as a client and you would have shown some really good returns. That continues to be the case. There's lots of cash on balance sheets. Some nice merger and acquisition activity could take place going forward. And I do see equity markets giving you sustained returns going forward.
Rod, are you basically betting on the end of the world?
No, not entirely, Bronwyn. I'm just saying what the gentleman just said there. He's saying that, I mean, technically a year ago on this program, we said that at 670, we said the rand is going to weaken over the next 12 to 18 months, which it has done by 20%. And we said that the best place to park is to park in either stable funds, if you're a low-risk client, which have delivered 10 to 12, which has beaten general equity. And what I'd like to just specify there, most retail clients invest in general equity, not industrials or small caps or financials. They invest in general equity. And general equity has done, on average, out of the general equity funds on year to date, has done 6.7% as an average of the 86 funds. So yes, industrials have done very, very well, but there's not many retail clients that sit in an industrial fund with all their assets. They diversify into a general equity space, and general equity has actually only done 6.7 on average. Your stable funds and your income funds year to date, 12 months to date, have delivered between 11 and 12, and the currency bet has delivered 20. So a year ago, the two bets that we put to our clients have delivered more than general equity. I hear what you're saying in terms of industrials, but industrials have run very, very hard with a lot of foreign money dominating there. When the trouble hits the fan in 2013 and 14, the foreigners, like they dumped our building stocks like Murray and Roberts in the 2008 crash, when those fell 80%, the same could very well happen to our industrial stocks. And let's not forget that 2008-9, those foreigners left our shores and our stocks fell 50% in 6 months. And that was only 3 years ago. So from a cyclical perspective, we're saying that the stock market here has rallied nearly 90% in 3 years. That's an average of over 30% a year for 3 years. The long-term history of the JSE is 13% a year. If you don't see that as a warning sign to being overvalued, and I know that the stockbrokers always say that the earnings will unwind with new earnings, but what they're not pricing is history and long-term averages and the distance we're away from the mean. The mean is about 40% below, the long-term mean from 984 in our stock market. It's about 40% below the current price. And we all know that bubbles.
Rod, I've got to get Derek. I've got to give Derek. I have to give Derek right to respond here. So Derek, it's all yours.
No, sure. And what you're saying, Rod, does make sense. But if you look at it from an opportunity cost point of view, what you're saying is that essentially that the world could come to a halt, and you know, there's a lot of downside risk in 2013, 2014, which is what you're saying there.
Correct. Yeah.
Okay.
Correct. Yeah.
Where we are at the moment is in 2012. There's an opportunity cost of where we are now to the point that you do see that downside risk play out. And that, at this stage of the game, is an assumption. So, in my opinion, if you're sitting on cash, where do you put it? You can't sit on cash because interest rates are so low. You can go into the rand or into the currency play at this point in time, but the question is, how can you predict information flow that's going to cause the collapse in the global environment and that flurry into safe haven assets such as US treasuries, etc.? So what do? You go into stocks or equity markets that will give you yields that will outstrip inflation and outstrip what you could potentially earn in cash. And let's look at it and face it, there are some really attractive yields on our domestic market at the moment. And local stocks continue to perform well. So yes, although you do have foreign investment that is also dictating, particularly in the retail space, which does suggest that there could be some nice downside, there have been some fantastic returns and you can't deny that. So if you look at it on a pure yield play and a growth prospective play, I think that the equity market is still attractive, and going into the rand is a little bit way out of my risk parameters, in that it's going to be driven by information flow.
Sure.
So Rod, you're right to respond to that. You don't have to keep quiet. He's just put his case
No,
to
sure,
you.
Bronwyn. I mean, a year ago we were on this program and we called the rand at 670, sell your rands, buy dollars. And we were met from various players on your show as saying that was quite an outlandish call, quite an aggressive call. Exactly a year ago, we
But
actually
Rod,
put the
but
document
Rod,
out on
it
a
hasn't.
website, Business Day's website.
It hasn't gone in a
Took some
straight line. It hasn't gone in a straight line. We're talking about one of the most volatile currencies in an emerging market environment.
Well, Bronwyn, from 670 to 820 today is above 20%. The general equity and the index, all share index, has done 6%. So the currency play has beaten it, and we went live on that saying that. So I'm just saying our forecast now for the next 2 years is we forecast continued rand weakness. Yes, it is volatile, and yeah, sure, it might go back to 8 in the next couple of weeks.
It might go back to 750. It may go back to 7.
Well, I don't think so. I don't think 7, Bronwyn, but I'd certainly say, like we said a year ago, we're saying rand 2 years out from now and closer to 10, 11. Shares to be negative and gold bullion to continue rising because of the debt situation. When you've got $16 trillion of debt in America, $7 trillion of debt in Europe, and no one knowing how they're going to work it out, you have to be a little bit naive if you don't think that gold's going to continue rising and shares are going to come under pressure. And I think you must bear in mind that the institutions out there are always positive on shares, and they were positive on shares before the 2008-9 crash. That dropped 50% in 6 months, and no one saw that coming, and they said the earnings were going to be great and unwind the PEs. Fundamentals don't warn you of a stock market crash. I'm not saying there's going to be a stock market crash imminently. I'm just saying in the next 2 years, I think equities have got a good chance of performing negatively, and I think people need to be aware of that.
Absolutely, and as you said earlier, you're in Clive Roffey's camp, aren't you?
Well, I'm not in his camp. I'd like to reiterate. I'm saying I just saw him on TV the other day doing a technical session about the JSE All Share showing a massive divergence for the last year. No, a whole year of diverging still hasn't fallen, but it's a warning sign, and technical analysis does give warning signs, and I think Roffey is correct on this particular asset. He's been wrong on numerous other calls in his life, but on this particular one, I think he's actually correct in that the divergence between the new high by 1 or 2% is actually a divergence away from the MACDs, and that is a leading indicator. One of the things we look at, of the many things. The other thing we look at is the fact that 30% a year from the previous lows over 3 years is almost 100% return in our stock market.
Before we end, we're almost out of time.
Right. Earnings are going to unwind. I don't agree with that.
We're almost out of time. I just want to pick up on one more comment that you made, that you'd be crazy not to think that gold is going to go up. You stand by that?
I say on a 3-year view, gold will be higher than $2,000 in the next 3 years. We're thinking potentially 2,500. As a matter of fact, Citigroup, HSBC and Goldman Sachs share that view, and no one talks about gold. It's been the best performing asset for the last 8 years. The best performing asset, no private clients own it, and the 3 biggest banks in the world are calling it above $2,000 by the end of this year, and yet no one talks about it.
I take exception. Rod, I take exception. I take exception to that. If you've been watching our show as much as you've been watching Clive Roffey's show, you'll understand that we discuss gold extensively here on Investment 360 and on Business Tonight. So thanks very much for your time. But a lot of those customers have been saying that gold, but a lot of them are saying that gold is topped, and we don't agree with that. 100%. The market is full of divergent views, and best of luck on your calls. Rod Lowe, Director at Investonline.